Hi there, I'm Paul Archowski. Welcome to 2021. I'm here today with Michael Moskal, our Director of Investments, and Scott Lipa, our Senior Investment Analyst, and we're going to do our first investment update of 2021. So with that, I will turn it over to Michael.
Well, thank you, Paul, and Happy New Year, everybody. I hope this video finds you all and your families healthy and safe. It's NFL playoff time, and I want to give a big shout out to our hometown Cleveland Browns here, who won their first playoff game in 26 years. Most of us here are a little bit tired today from staying up late watching the game, but it was well worth it. It is NFL playoff time, and there's a commercial that the NFL has that advertises the playoff teams. And they have in the background some 1990s music going on from Shania Twain, where she says, "It looks like we made it." And I think as 2020 drew to a close, that many of us were feeling that way, that it looks like we made it. And we did make it through 2020. And we just would like to see a more positive and better 2021 coming up. So with that, let's go ahead and get into our discussion. Stocks and bonds in 2020, as many of us know, rallied through all the bad news. And we all know there was a lot of bad news in 2020. COVID-19 hit in the spring, and we're up to 21 million cases here in this country, 365,000 deaths. Now, there is a positive, of course, with the vaccines coming out, and there's light at the end of the tunnel with COVID. But COVID caused the U.S. economy to shrink 5.6% in 2020, which was a loss of $1.2 trillion of economic output. Corporate profits dropped 33% year over year. And again, there's a positive here because as we go through 2021, we're going to see corporate profits getting better year over year and improving. 11 million people are still unemployed as of December, and we do need to improve that area and get more people back to work, as we know areas of the country are shut down. And we just went through a contentious presidential election, which did not add to the positive mood, added to the negative mood. So, with all that bad news though that happened, what was the reaction of the Federal Reserve, our central bank, and Congress in this country? A tsunami of money, flooded into the markets and the economy as the Federal Reserve printed about $4 trillion in 2020. And they're still printing, by the way, about $120 billion a month. And what are they doing with all that money? They're buying financial assets, primarily bonds. So mostly government bonds, but for the first time in 2020, the Federal Reserve started buying corporate bonds and other kinds of assets. Why'd they do that? The intention there is to push interest rates down, because as they buy bonds, it increases bond prices, which push rates down lower. They want rates down lower so that you and I go out there and borrow money and spend more money, because we have 70% of our economy is you and I spending money. So all this is geared towards us getting out there and spending more money and make the economy look better. If you add in the JCB, which is the Japanese central bank, the ECB is in Europe, and the BOE, which is Bank of England, if you add in what they did, they added another $4 trillion of printing money and buying assets in 2020. So you have about $8 trillion total if you add the US and these other banks of stimulus, we would call stimulus in 2020. The US Congress added another $3 trillion in economic aid. That's why we call it a tsunami of money. There's just a lot of money that was put into the financial markets and the economy.
Hey, Michael,
this was really
Michael, I have a lot of clients ask me, and I'll ask you the question that I get, because I'm sure you've heard it as well. Clients asking me about the disconnect between what's going on economically and what's going on with the market. So the markets have rallied, and it's because of this tsunami of money, but I feel like a lot of clients are waiting for that other shoe to drop, where we shut the country down for a couple of months back last March, April. Unemployment is high. There's a lot of negativity and negative things happening economically, yet the market doesn't reflect any of that. How do you address that with clients?
Yeah, and Scott, I think our last video we did, that we said that was the number one question that clients were asking us, or topics that people were bringing up, is I don't get it. I like it because it makes my accounts are going up in value, my investment accounts, but I don't get it because I look down the street at my neighbor, he's out of work and the restaurants are closed near me All these things don't look good from the economy's perspective, but the answer is the tsunami of money, of course, because if you didn't have the tsunami of money going in, we still would be in a very, very deeper recession than we already are. And I seriously doubt the investment markets would look the way they do. So the confidence that's been put in there. Now there is a negative, and for people who understand how this is all working, of course, because this is not free money. When we talk about printing $4 trillion and Congress adding $3 trillion, that's all borrowed money. That money's coming from debt. So this debt's going to have to be repaid down the road, but we don't know exactly what that means. Specifically, we do have our ideas as we get further into our discussion here. We talk about inflation down the road, but yeah, there's no free lunch here. But money can make things look very good. If I go out and go to the bank and borrow $50,000, if I could get it, I could go out and buy lots of stuff that would make my neighbors say, wow, look at that. He's buying cars and all kind of stuff, but I still owe the money down the road. So it can make things look good for a while. Somewhere down the road, we got to pay it back. And we'll just,
I think what you're saying, I think a lot of what you're saying is we're borrowing, basically what we're doing is printing money and borrowing future growth. I mean, you can't, we're manufacturing growth today that we probably would see over the course of the next 5 to 10 years. But, what does that mean for 5 to 10 years from now? Does that mean slower growth, lower growth? Because we're manufacturing it now and taking it all today relative to over time.
Yeah, I think we could use our model of the last 10 years and look at that, because we had a chart in our last discussion where we showed the S&P 500 growth over the last number of years, the GDP or our economic growth in this country, and then we showed corporate earnings. And the stock market has far, far outpaced corporate earnings and far, far, far outpaced economic growth. So I think that model, Scott, is probably going to be the same thing we're looking at. We look at the next 10 years, slow growth. Like you said, the money's coming from somewhere and we're borrowing a lot of future growth to do it. So, the more question for us, of course, is that how's it going to affect clients' investment accounts? And so the focus right now for us is going to be on the Federal Reserve and what the central banks are doing, because they can make things look good for some time. It doesn't mean things are going to crash next year because of all this. It could be a number of years, before we see the effects of this. So that's something we need to figure out, of course, for our clients, and why we always have our discussions, not only here, but weekly in our investment committee meetings. I was going to say this chart, if all the stimulus was a country, it would be the third largest country in the world. So to put that in perspective, as far as how much money $8 trillion is. All that money, of course, last year pushed asset prices up. We had a really tough first quarter. March was a very scary month for everybody. Stocks went down, bonds primarily went down. Other assets went down. The only assets that were up that first quarter were government bonds, which are safe havens of money, and gold, which is another safe haven, was up in the first quarter. But we had a pretty scary time, pretty significant declines. But since then, again, when the government and the Fed stepped in and started putting money in the system, it provided a lot of confidence besides just a lot of money, and it made things come back. And we had significant rebounds by the end of the year. Interestingly enough, you look at the stock market. I just had this discussion this morning with a client because he asked me how the market did for the year. I said, what do you mean by the market? What do you mean by the stock market? Because big differences in returns, depending whether you're talking about technology stocks, which are reflected in growth and S&P here, versus value, which are hospitality industry, the hotels and airlines and those kind of companies. They struggled much more. Still ended up positive, those stocks, for the year, but a big dichotomy this past year. Matter of fact, Scott, you'll remember, and I bring this up sometimes about, I think you were with us maybe for about a year or so, 1999, and looking at Barron's, and we had a similar kind of situation with growth and value, where we had such a huge dichotomy between technology and growth stocks and value stocks. And so this past year, we had 37 percentage points of difference if you look at the Russell growth versus the Russell value here. And that's the biggest difference we've had since 1999.
I think what's interesting about this is the difference in returns. I look at the NYSE as sort of the entire market and probably a better barometer for what individual investors would be up for the year, the 3 to 4% range, not the 16%. I feel like the 16% was just it was the shelter in place tech trade that started in March. And it was just a handful of technology stocks that carried the entire market through 2020. I don't think it's a broader representation of what's going on with a lot of companies that are surviving on PPP loans and in a lot more difficult position maybe than some of these tech companies like a Zoom or I think of Zoom because I think they were up over 500% last year. But that handful of stocks that carried the whole market, I think there's a huge disconnect between that and what's going on in the broader markets.
Yeah, as a matter of fact, in one of our investment committee meetings last year, we were talking about the top 5 stocks in the S&P that had the same return as the bottom 495. They were driving everything. They were equal to the same as far as looking at the market capitalization of those companies. So yeah, it was just a few companies. I don't look at the S&P 500, at least not right now, as representative of the stock market, like you just mentioned, Scott, because you got 30% of that index is made up of tech stocks. And out of those tech stocks, you just have a handful that are making up the tech area. So you're exactly right. I think we look at it as value line, which is more the average investors index that has big companies, small companies, even has some real estate. It's trying to be more indicative of what people would be investing in on a diversified portfolio, or the NYC composite, which is all stocks in the New York Stock Exchange. So yeah, 3 to 4%. If someone asked, that was the answer I gave my client this morning, by the way, I said, look at 3 or 4% is more what market did last year, on average. So, bonds came back last year from where they were in March. Again, that's a lot of government money in there, a lot of Fed money pushing investment grade corporates up. Government bonds finished up 2%. Oil came way back. It still finished down 23%, but it was down 66%. And that was, again, with a lot of money coming in there, it made the economy look a little bit better. So oil has a lot to do with our economy. And gold finished up 22%. What do we see ahead in 2021? We think it's going to look, somewhat similar from the perspective of this tsunami of trillions of dollars continuing to be pumped into the economy and the investment markets from the central banks and federal government. Where's it going to go? Of course, President-elect Joe Biden has said first thing he wants to do is to get more COVID-19 relief going. So I think the word he used was trillions, not trillion, but trillions with an S on it. So we probably can look for that coming out. Infrastructure is another big thing they talked about spending trillions on. National health care, which was something floated by Bernie Sanders during the campaign last year. That was something floated also. So, this whole concept and we should probably get used to hearing this term modern monetary theory, this MMT, which is just economists speak for the governments being able to print really almost as much money as they want. And as long as the central banks will keep interest rates down near zero, they keep interest costs down, which means they can just keep printing more money. And again, we'll get back to it. It's not free, folks. Somewhere down the road, we're going to have to pay for it. And but right now, it can make things look much better, including the investment markets.
Yeah, I think I'm pretty positive or optimistic about 2021 for that reason alone. And in my mind, maybe April or May is sort of a finish line for this. And what I mean by that is January, you're going to have a stimulus check. February, March, you get into tax refund season, and the average American that gets a refund will spend that refund. Then you have a widely distributed vaccine by April, May timeframe, and the country reopens up a little bit. I think there's a lot of tailwinds for the market in 2021. So when people say, people are a little concerned that the market is overvalued, and I would agree in a lot of senses, the market is overvalued, but it doesn't mean it can't stay that way for an extended period of time. And I feel like that's going to be the theme throughout 2021 is, yes, the market's overvalued, but there's so much money in motion that it can continue to be overvalued and continue to go up, even though valuations are a little bit lofty right now.
Yeah, well, we saw it back in the late 90s, right? When Alan Greenspan, who was the Federal Reserve chairman at that time in the 90s, when he said the words irrational exuberance, when he was referring to the stock market, it was getting a little frothy in his view. It was 1996. So, we had 3 more years to go with this market going up and up and up. And, market tops and market bottoms are really, really hard to try and gauge, where the top and bottom is. And so, we try to help, of course, our clients when things do get frothy, just to warn a little bit and say, maybe this is not the time to take maximum risk, but you still got to be exposed because expensive can get more expensive, So, yeah, I mean, 2021, we'll see what happens. Here's my only cautionary tale with all this is that previous president, President Trump that was in there, we know he was a strong advocate for the stock market with the tweets that he made all the time. He would tweet. I don't necessarily, and I know Scott, you and Paul, you too, we didn't see that as necessarily healthy when he was putting his whole president success on the stock market. But it was what it was, so he was pushing very hard to get stock prices up. And I don't know, we'll see with the new president. I don't think it's healthy that they should be involved that much in the stock market anyway. But I haven't heard that necessarily from President-elect Biden. So we'll see what happens. That's my only thing about that is, what could hurt the stock market is if the support for the Fed, is not there with Congress. If Congress and the president don't support the Fed like they have in the past 4 years, you could see, some of that trillions of dollars of support sort of come off the table, which would hurt the stock market. But that's something we got to kind of keep a close eye on. Where's this money going to go? We talk about, asset prices going higher still with stocks. Scott, you just talked about that for the next few months, at least, we think. There's going to be sell-offs and corrections along the way, but it may look different. So 2020, as we talked about, may not be all this money being spent and the technology stocks being the beneficiary primarily. It may be different. We see the value sector, which was not, again, returns were positive, but just barely last year. They may be the beneficiary of where the spending is this year. So infrastructure spending favors these value sectors, looking at energy and healthcare and transports, financials, ICT is technology, water, food, public and legal, that whole industry, chemical, nuclear industry, different. The ICT, by the way, is not the online shopping technology stocks. That's more the infrastructure technology stocks like the Qualcomms of the world. So, it may look very different. We're looking at that. So we may be favoring, which we already have, and we'll talk about that in a minute. What have we been doing? We've been, buying a little bit more in the value area with the stock market.
Yeah, I think the tech trade that started back in March has and Michael and Paul, you both know this, but I mean, the valuations on tech stocks now are the highest they've been since 1999. So you figure at some point we have to see that rotation out of the growth or away from the growth and into the value where you can actually find some values. I mean, it's very difficult to find value on the technology or the growth side right now, versus relative to the value-oriented stocks that we're talking about. So I like the idea of moving toward value more so than we already are. We already are overweight value, but just because that's the only place we can go right now and find some value and generate some earnings for clients without overpaying like we would if we were real heavy technology right now.
Yeah, well, cycles change, and we know that. We've all been around long enough to know that these cycles change, and sometimes value's in favor, sometimes growth is in favor. Sometimes small caps are in favor, sometimes large caps are in favor. So, our job is to try to gauge where these cycles are, and try to be buying value for clients. Whether there'll be a time at some point where the growth stocks are going to be cheap. It's not now; they're very expensive, but at some point in time they will be. But right now, Scott, absolutely, you're 100% correct. We're looking at these sectors already. You look at some of the sectors that will be favored, with some of the inflation trade also. All this money printing, right now we've not had inflation for a lot of years. And part of that's because the money that's been sloshing around in the system has been printed by the Fed, and it's been the Fed buying assets with it. Now, we're looking at the government more printing the money and them spending money out in the economy. That's a very different thing. And when that happens, what they're spending money on tends to push up prices of things that people are buying or prices of things that go into what they're talking about. So, if higher inflation, and I was on a call, Jeff Goonlock, who's considered to be the bond king, he owns Double Line investments. And, he was talking about, he thinks inflation will be hitting 3% by June of this year. He says all this money printing, it's got to be showing up. And the reason why is because now it's out in the economy, which means people are buying things and they're buying more of things. We talk about, so it pushes prices of products up. And that's why we look at things like consumer staples, which I have the graph in here of Cheerios and Hershey's and Tide. These are things people are going to buy even if prices go higher. They're going to buy them anyway. That tends to push prices up too with inflation. So gold stocks are beneficiary, energy stocks, people are going to keep gas in their car. Consumer staples, utilities, people are going to, they're going to turn the lights on regardless of how prices are going. Healthcare is the same thing, material stocks. And I put Bitcoin in here. I don't know. Bitcoin's still kind of one of those wild cards for me. I understand it. I still don't understand it. It's one of those kind of weird things. I'm like, is it worth something? What's it really worth? How do you value Bitcoin? I don't know.
Those are the exact same words I use with a client. It's like, I just don't understand it. It's there, and it's a hot item again, because I'm getting a lot of questions about it, especially with the big run up we had recently, but it's interesting.
I like the concept of, I think maybe what the appeal is the concept that you have a currency that's not beholden to any sovereign, right? You can't, right now we're talking about how we're printing money. We're just printing money, and printing money basically devalues the money that's already out there. So we can manipulate the value of a dollar as a country, we can. But if a currency is not tied to any country, in my mind, it would be a little bit more difficult to manipulate the value of it. So, but that being said, I still don't understand how you mine it or what exactly it does, or how you use it actually.
Yeah, there's a lot of questions with it, as far as where did it even come from? There's the whole myth of some Japanese person created this thing, and there's only 18 million of these things or something like that, or whatever the finite number. It's like, well, how do we know that? I mean, who knows that? How do we know that? There's nothing published about it. I don't know, who knows? So, but the whole concept of digital currency actually is very appealing, of course. It is hard to think that the government isn't going to get involved at some point in time and say, we'll just have our own digital currency. Why don't use Bitcoin? Why we got to do it? But anyway, yeah, I brought that up because right now it seems to be the thing that's been happening. It's down today, but it seems to be the thing that's been happening. And just so people who don't know Bitcoin, it's not actually a coin. I know the picture down here has someone holding an actual gold coin that has a B on it, but it's pure digital. I actually ordered some actual Bitcoins that they're not worth anything, but they're little coins. But we'll see what happens with the Bitcoin. This was really interesting about value. Value has not been in favor for some time. And matter of fact, it's gotten the cheapest. This goes back to the end of 2020. Now we're a little bit different, but it's gotten the cheapest relative to growth since 1981. That's a long time. That's before any of us were working yet. Even you, Paul. So a couple of years before Paul started. So value has gotten so cheap. And again, these cycles change. You can see the graph here. It goes up and it goes down. And at some point in time, value is going to have a big run. Scott, we go back to, and Paul, back to the days of 1999, we started buying small cap value. You guys remember that? And we were kind of, the guy who was selling the funds at that time, not clients, but the guy who was selling us the funds said, man, why do you want to do that? It's all growth, buy technology. It's like, yeah, but
our wholesaler thought our Putnam wholesaler thought we were crazy. I remember that. But and I think we were a little bit early, but not too early. We actually timed that really, really well, because 2000 and 2001, small value did extremely well. Yeah,
so we bought small cap value. It was about the middle of 99. Mm-hmm. Technology still ran very hot those last 6 months of 99 and into the couple months of 2000. And then the whole thing collapsed. And small cap value was the best performing sector in 2000, 2001, and 2002. So we had a nice 3-year run on it. So what we're doing now with value and buying value, I'm pretty confident it's going to pay off in the next 2-3 years. What else have we been doing or planning to do? We've increased international. And again, this is an area that we've been underweight for 10 years, really, which has been great because the US has been dominating for the last 10 years. So it's been better not to be invested very much in international the last 10 years, but we do think that's going to change. Again, I put especially Asia and Southeast Asia on here because, what dominates Asia is a country called China. And, love them or hate them, China is growing very rapidly. And whether people like to hear this or not, at some point in time, China is going to probably overtake us as the largest economic country in the world. So that's going to be the place to be. That's where the growth is in Asia. Southeast Asia countries are like Malaysia and Singapore, and they provide a lot of supply to China. So they're going to be beneficiaries of China growing. It doesn't mean, by the way, the US is going to go down the tubes. When we say that, the US is still going to be a very great place to be investing, and a place to be. It just means that China is going to be growing more than we will at some point in time, probably. So that's something, Scott, I think we've been looking at, and we've already increased our international positions and probably looking at doing a little more with that. We talked about inflation-oriented sectors, having something allocated towards those sectors. We have decreased technology, but only because it got to such a big portion of what our portfolios were, right, Scott?
Yeah. The outperformance of tech has caused it to take up a large percentage of overall allocation. So just paring back a little bit, taking some gains, and like we talked about, it's probably the single most overvalued sector of the market right now. It doesn't mean it can't continue to be that way, but it doesn't hurt to take some gains at this point.
Yeah, technology is not going to go anywhere. I mean, what happened during this whole COVID event that we had probably just speeded up what was going to happen anyway over a period of years.
Yeah, I heard somebody explain what happened with COVID and the shelter in place thing as it forced us to adopt the technology that we probably should have adopted over the last 10 years over the course of a couple months.
Yeah, well, I look at my parents. My parents are in their 80s, and they're fine with technology. My mom's pretty good about texting and doing her stuff on the computer and on her phone. But this speeded up them ordering food. They would have never ordered food online before, and had it delivered to their house. But they started doing that during the shutdowns, and so there's things like that people are doing that they maybe wouldn't have done, or wouldn't have done for a while yet, and they just started doing it. So now we're still very positive on technology. It's just some of those stocks, back in my early days, back in the 1980s, I got a chance to speak with John Templeton, who was one of my sort of idols in investments at the time. He was an investment Hall of Famer. And one of the first things he said that really stuck with me throughout all these years is you have to separate out, the companies from the stock price. The company may be a great company, but their stock price can get too expensive. You don't want to own it. So I think we're saying that about technology, that generally speaking, technology is a great place to be. There's a lot of great companies there, but sometimes those stocks just get so high priced, you just don't want to be heavily invested there. For bonds and fixed income, we still like higher credit quality. We're still not, overweighting in the lower credit quality. Fed has said they're going to have rates to zero until the end of 2023. So we kind of know it's going to happen unless something unusual happens. So you still can have some return there. International short-term corporates, institutional CDs. I don't have it on here, but floating rate notes are another area of fixed income that can probably provide some yield. Especially if we do see inflation go up higher and see rates tick up a little bit higher. I don't think, Scott, that we see rates spiking up too much because the Fed, I don't think they can afford to do it. When you're borrowing as much money as we are as a country, and you're issuing as many bonds as our government is, we can't really afford to have rates spike up and have the interest costs go up too much.
No, it's crazy to me. It's crazy to me that the Federal Reserve came out and said they won't raise rates till 2023. To give guidance that far in advance seems a little bit crazy. And one thing we haven't talked about is all the unintended consequences of keeping rates that low are at zero. It's one of the things that's really pushing a lot of money into the market right now. And in my mind, it's the risk a lot of retirees run right now is not being aggressive enough with their investment portfolios because of what the Federal Reserve has done. You can't afford to be super conservative with your investments, with your bond portfolio, because there's no yield to be had. So I think with a lot of clients right now, I probably have a little bit more stock exposure than I should relative to age and risk tolerance, just because you can't afford not to because of what the Federal Reserve is doing. And secondly, with what the Federal Reserve is doing, and I've seen it here at my house, is another unintended consequence, I think, is a little bit of a housing bubble that we're creating. I think people are getting bigger mortgages and paying more for homes than they would typically because interest rates are so low. And I'm seeing it here on my street. Houses go within a few days and they're going for considerably more than they would have a year ago at this time. So these interest rates at 0% push money into the market, but I think the unintended consequences, we'll have to see what comes of the unintended consequences in the years to come.
Yeah, without a doubt. You know, the 0% is not a natural rate of interest on borrowing cost, or else nobody would loan money to anybody over time. You know, so normal interest rates are somewhere in the range of 4 to 5% over, and I'm talking about over thousands of years of interest history. You know, people borrowing money and paying money back.
I don't know about you, Michael, but I think it'll be years before we see 4 or 5% interest rates. I mean, like, I don't know, 5 years, 7 years. It's going to be a long time before we see normalized interest rates again.
Yeah, unless something unusual happens. That's why I said they're always, you know, we always have in the back of our minds here. This is not all guaranteed stuff that we're talking about. You know, things can change very quickly for all kind of reasons that we can't even see right now. And, you know, of course, that's what we're always talking about in our investment committee meetings about what can go wrong here, or what can change this whole scenario from not coming out this way. So, but yeah, I mean, this is not a natural thing. And when we talk about some of these things, you know, we have our own personal, you know, historical biases towards some of these things and opinions on these things. I don't think it's healthy, as you, Scott, and you, Paul, think about having zero rates for too long, you know, but we are operating in the environment that we are in. So we look at this and say, if the Fed's going to have zero rates for the next few years, what do I do with my clients' money? You know, how do I help them the most? You know, so that's the construct that we are involved in. You know, for your investments, you know, what should people be doing? Again, there's a lot of noise every day, and we hear it every day. There's noise, you know, when I'm working at home and I'm watching CNBC and Bloomberg News, every 15 minutes, there's something new coming out. Oh, breaking news, breaking news, breaking news. You know, so, but, you know, for people in general, sticking to the longer term investment and financial plans. And if they don't have one, they got to get one. You know, we can certainly, if you know, people listening, if they're not sure how to do it, ask us, you know, we'll help you with it. But, you know, part of that's, you know, making a comfortable risk and return goal for yourself. You know, if you have an investment risk and something and all the ups and downs of the market cause you to lose sleep at night, you're probably too risky. You know, so those are the kind of things. Also, you know, the first thing that people probably should be doing is try to think through at retirement and say, what kind of money do I need? You know, what kind of money do I need to live on? Because everything sort of filters into that. You know, if you need X dollars and then you say, well, I have a certain amount of money now, is that going to be able to grow enough for me to be able to retire on that amount of money? Other things I've seen people forget about too is all sources of income at that time, at retirement. You know, for us, certainly, now maybe for someone who's 20 years old, maybe Social Security is going to look a lot different. But, you know, certainly people in their 50s and 60s and, you know, beyond, Social Security is not going to probably be touched much. You know, they may increase the taxes on it or something like that, but they're not going to take it away. It's a political hot button, but that's, you know, it's a big source of income for people sometimes. So, you know, 401k, IRAs, personal savings, all those things have to go into building a personal financial plan. All right. Any other comments, Scott or Paul?
No, I think you summed it up nicely.
All right.
Should be a
Well,
fun
we're
year.
okay. We're at the end of our update. And again, you know, wishing everybody really a healthy 2021. You know, there's a lot of anxiety last year, just in general. The markets did okay near the last part of the year, but, you know, just in our personal lives, a lot of anxiety. You know, we're looking forward to a much better 2021 in that regard. So with that, I guess we'll sign off, and we will be speaking to all of you sometime soon.
Thank you.